Alright, Alex John here, and I need you to lock in for the next few minutes. On February 4th, between 29 and 3:30 p.m. Eastern Time, something broke in the credit markets that hasn't broken since March of 2020. Corporate credit spreads in the high-yield bond market widened by 140 basis points in a single trading session. By market close in London, spreads had pushed to 18 on the CDX index. Now, if those numbers don't immediately set off alarm bells, let me be crystal clear about what this is and what this is not. This is not a crash. This is not panic selling driven by headlines. This is not speculation or theory. What you are watching is the repricing of counterparty risk across the entire leverage lending system, and it is happening in compressed time. Lenders are stuck. The credit mechanism that funds corporate America that rolls commercial real estate debt every 90 days that keeps the zombie companies breathing is seizing up. And when credit stops flowing, everything downstream breaks. Not in 6 months, not after a policy announcement. Now, over the next 25 minutes, I'm going to walk you through the mechanical breakdown of what's happening in the credit markets, why this spread blowout is the final warning before a wave of defaults that will dwarf anything we saw in 2008, and most critically, the 3 asymmetric positions you need to understand right now if you want to protect your wealth and capitalize on the dislocation that's already begun. By the end of this video, you will have a clearer picture of systemic risk than 99% of retail investors, and you will know exactly what to do about it. So stay with me until the very end, because this is not a drill. I have watched this pattern before. The names of the institutions change, the instruments change, the mechanics do not. When credit spreads widen this quickly, it is because someone somewhere in the system stopped being able to roll their debt, and the market is now pricing in the possibility that more will follow. This is not about sentiment. This is about solvency. Let me walk you through what has happened in order. Because in credit markets, sequence matters more than headlines. January 28th, a regional asset manager in Dallas disclosed that it had missed a margin call on a collateralized loan obligation. The disclosure was buried in a footnote, no headline coverage. But what matters is this. The CLLO was backed by corporate loans to mid-size leveraged borrowers. Those borrowers had been refinancing on 90-day cycles. That cycle broke February 1st. 3 days later, a separate fund in the same asset class suspended redemptions, not because of losses, because it could not sell the underlying loans fast enough to meet withdrawal requests. The loans were still rated investment grade, but there were no bids. February 3rd, overnight, the spread on BBB-rated corporate bonds widened from 4.2 to 6.8. That is a 260 basis point move in less than 12 hours. By the next morning, 2 more funds had gated withdrawals. This is not coordinated, this is sequential. Each institution is reacting to the same structural problem. They cannot exit positions without moving the market against themselves. And every attempt to exit makes the next exit harder. Now look at the repetition. Dallas fund gated, London-based credit vehicle gated, a pension-linked leveraged loan ETF suspended creation units. These are not the same institutions. They are not even in the same jurisdiction, but they are all facing the same constraint. Illiquid collateral in a system that assumed liquidity would always be available. And here is what matters. The time between each event is shrinking. January 28th to February 1st, 3 days. February 1st to February 3rd, 2 days. February 3rd to February 4th, 1 day. This is not escalation. This is compression. The system is running out of time to absorb stress without forcing decisions. Let me explain what this means beyond credit funds. Corporate borrowers in the leveraged loan market rely on the ability to refinance every 60 to 90 days. They do not hold enough cash to pay off the loan, they roll it. If spreads stay this wide, rolling becomes prohibitively expensive. Some borrowers will choose to default rather than accept terms at 12% over benchmark rates. That is a rational decision. But here's the second order effect. The lenders holding those loans are regulated banks. U.S. regional banks hold approximately $680 billion in leveraged loans. European banks hold another $400 billion. If defaults rise, those banks face mark-to-market losses on their loan books. That affects their capital ratios. That affects their ability to lend. That affects deposit confidence, not immediately, but in sequence. And we are already watching the first part of that sequence play out in real time. 3 banks have quietly tapped the Federal Reserve's discount window in the past 72 hours. That data is disclosed with a 2-week lag, so the public will not see it until mid-February, but the banks know and they are acting. Now here is where the timeline becomes critical. On February 10th, $87 billion in leveraged loans come due for refinancing. On February 15th, another $63 billion. These are not optional dates. These are contractual deadlines. If spreads remain above 10, A significant portion of those borrowers will not be able to refinance at terms they can afford. They will either negotiate extensions, which requires lender approval, or they will begin restructuring conversations. Both options take time, and time is the one resource that is now scarce. Meanwhile, the funds that have gated redemptions are facing their own deadlines. Most redemption suspensions are capped at 30 days under fund rules. After that, they must either reopen or liquidate. If they reopen and withdrawals resume, they will be forced to sell into an illiquid market. If they liquidate, the selling pressure accelerates. There is no scenario where this resolves without further price discovery, and price discovery in an illiquid market means wider spreads. So here is what we are watching for. First, whether any of the gated funds move to full liquidation before February 10th. If they do, that will set a floor price for leveraged loans, and that floor may be lower than the market currently expects. Second, whether the banks that tap the discount window begin disclosing balance sheet stress. They are not required to disclose immediately, but if deposit outflows accelerate, they may be forced to. Third, whether corporate borrowers begin pre-announcing refinancing failures. That has not happened yet, but if spreads stay above 12 for more than 5 trading days, it becomes likely. Fourth, whether regulators step in with emergency liquidity measures. The Fed has tools. The question is whether they deploy them before defaults begin or after. What we do not know yet is how much of this stress is confined to leveraged credit and how much bleeds into investment-grade bonds, municipal debt, or structured products. That will depend on whether lenders pull back across the board or just in high-risk segments. We will know more by February 12th. To understand why this matters, you need to look at history. Because this pattern, credit market stress leading to systemic breakdown, has played out twice in the last century, with devastating consequences for those unprepared and life-changing wealth creation for those who saw it coming. The first parallel is the Great Depression, and specifically the credit crunch of 1930 to 1933. Most people think the stock market crash of 1929 was the main event, but that is a fundamental misunderstanding of what actually destroyed wealth. The real devastation came in the years after the crash when the credit markets froze. Banks stopped lending. Corporate borrowing dried up. Credit spreads exploded as lenders realized that the debt bubble of the 1920s was built on a foundation of sand. Between 1930 and 1933, over 9,000 banks failed in the United States. 9,000. These were not small regional institutions. These were the pillars of the financial system. And they collapsed because the borrowers could not pay. The collateral was worthless, and the credit mechanism seized. What is critical to understand is that the investors who preserved and grew their wealth during this period were the ones who recognized the credit warning signs early. They moved out of overvalued equities and corporate bonds and into hard assets, particularly gold, which was revalued from $20.67 per ounce to $35 per ounce in 1934. A 69% gain while the rest of the economy was in ruins. They also bought deeply distressed real assets, farmland, industrial equipment, and even entire businesses at pennies on the dollar. The lesson here is not to predict the exact timing of the collapse, but to recognize the structural imbalance and position accordingly. Credit spreads blowing out in 1930 were the final warning before the full systemic breakdown. Those who heeded that warning and repositioned their portfolios were the ones who emerged wealthier on the other side. The second historical parallel is the stagflation crisis of the 1970s. And this one is even more relevant to our current situation. In the early 1970s, the United States was drowning in debt from the Vietnam War and Lyndon Johnson's Great Society programs. The Bretton Woods system, which pegged the dollar to gold, was collapsing because foreign governments knew the U.S. had printed far more dollars than it had gold to back them. In 1971, Nixon closed the gold window, and the dollar became a pure fiat currency. What followed was a decade of chaos. Inflation soared into double digits. Interest rates skyrocketed. The economy stagnated and credit spreads, you guessed it, blew out. Lenders demanded massive premiums to compensate for inflation risk and default risk. Corporate borrowing became prohibitively expensive. The credit mechanism did not freeze entirely like it did in the 1930s, but it became severely dysfunctional. And here is the key insight. During this period, traditional 60-40 stock and bond portfolios were destroyed. Stocks went nowhere for a decade when adjusted for inflation. Bonds got crushed as interest rates rose, but gold, silver, and other hard assets exploded. Gold went from $35 per ounce in 1971 to over $800 per ounce by 1980, a 200% gain. Silver went from $150 to nearly $50. Energy stocks, commodity producers, and real assets massively outperformed. The investors who recognized that the credit market stress of the early 1970s was a signal of deeper systemic rot and who repositioned into inflation hedges and real assets did not just survive the decade, they became wealthy beyond their wildest dreams. The lesson from the 1970s is that when credit markets signal distress in an environment of high debt and monetary debasement, the asymmetric play is to move away from financial assets and into tangible inflation-resistant stores of value. And that brings us to today. We have higher debt levels than the 1930s. We have more aggressive monetary expansion than the 1970s. And now credit spreads are blowing out just like they did before both of those historic dislocations. If you understand these patterns, the path forward becomes clear. Global debt has reached absolutely unprecedented levels. According to the Institute of International Finance, global debt hit $315 trillion in 2025, which is over 330% of global GDP. This includes government debt, corporate debt, and household debt. To put it simply, the world has borrowed more money than it can ever realistically pay back at current interest rates. For decades, this was not a problem because interest rates were at or near zero. Governments and corporations could roll over their debt cheaply. But now, with central banks having raised rates aggressively to fight inflation, the cost of servicing that debt has exploded. Corporations that borrowed heavily during the zero-rate era are now facing refinancing at 5%, 6%, 7% or higher. Many of them simply cannot afford it. And lenders know this. They are looking at the maturity walls, the mountains of debt coming due in 2026 and 2027, and they are realizing that a significant portion of borrowers are going to default. That is why credit spreads are blowing out. Lenders are pricing in a wave of defaults that has not fully materialized yet, but is absolutely inevitable. The second driver is the return of real interest rates. For over a decade, real interest rates, meaning the nominal interest rate minus the inflation rate, were negative. You could borrow money at 2% when inflation was 3%, meaning you were effectively being paid to borrow. This created a massive incentive to lever up, to borrow as much as possible, and invest it in anything with a yield. But now real rates have turned positive. The Federal Reserve's policy rate is above the inflation rate, and that fundamentally changes the calculus. Positive real rates mean that debt is now a burden, not a tool. It has to be serviced out of real economic productivity and in an environment of slowing growth that is nearly impossible for many borrowers. This is why we are seeing stress in commercial real estate, in leverage buyouts, in zombie corporations that only survive because of cheap money. The moment real rates turned positive, their business models became unsustainable, and lenders once again see this. They are pulling back, demanding higher spreads, and in many cases refusing to extend new credit. The third driver, and this is the one most people completely miss, is what I call the quiet mechanism of financial repression. Governments around the world are trapped. They have massive debt burdens, aging populations, and massive fiscal commitments they cannot meet without either defaulting, inflating the debt away, or engaging in financial repression. Financial repression is a policy framework where governments deliberately keep interest rates below the rate of inflation, forcing savers and creditors to accept negative real returns while the government inflates away the real value of its debt. We saw this after World War II, and we are seeing it again now. But here's the problem. Financial repression requires cooperation from the credit markets. It requires lenders to keep lending at artificially low rates. And when lenders start to rebel, when they start demanding higher spreads to compensate for the hidden inflation tax, the whole mechanism breaks down. That is what is happening now. Lenders are saying, we are not going to accept negative real returns anymore. We are not going to keep funding governments and corporations that are insolvent. We want higher compensation or we are not playing. And that rebellion is showing up in the credit spreads. So what are the three asymmetric plays in this environment? Let me be very clear about this. The first play is deep value in distressed credit and unloved sectors. When credit spreads blow out, it creates opportunities to buy high-quality assets at distressed prices. I am talking about investment-grade corporate bonds trading at discounts, senior secured loans with strong collateral and equity in cash-generative businesses that are being thrown out with the bathwater. The key is to focus on quality and duration mismatch. You want businesses with strong balance sheets and cash flows that are being mispriced because of broader market panic. This is how the smart money made fortunes in 2008 and 2009. They bought quality assets at Depression-era prices and held them through the recovery. The second play is leveraged inflation specifically in hard assets and commodity producers. If the credit market seizure forces central banks to pivot back to easing, which is almost inevitable given the debt levels, we are going to see another wave of inflation. The assets that benefit most from this are the ones with pricing power and tangible value. Energy producers, agricultural land, precious metals miners, and infrastructure assets. These are the assets that went parabolic in the 1970s, and they are setting up for a similar move today. The third play, and this is the systemic hedge, is physical gold and silver. I cannot stress this enough. When credit markets seize, when trust in the financial system erodes, when the currency itself is being debased through inflation and financial repression, there is no substitute for physical precious metals. Not paper gold, not ETFs, but physical metal that you control. Gold is not an investment. It is insurance. It is the ultimate form of wealth preservation that has survived every financial crisis in human history. And silver, with its dual role as both a monetary metal and an industrial commodity, offers even more asymmetric upside. If you do not have a significant allocation to physical precious metals right now, you are taking on uncompensated risk in your portfolio. Now, let me be specific about what you need to do immediately. This is your action checklist, and I want you to take this seriously, because the window for positioning is closing fast. First, you need to assess your current portfolio allocation and ask yourself honestly how much exposure you have to credit risk. If you own corporate bonds, high-yield debt, or equity, and highly leveraged companies, you need to understand that those positions are at risk in a credit seizure environment. I am not saying sell everything in a panic, but you need to stress test your holdings and reduce exposure to anything that relies on cheap credit to survive. Second, you need to build a position in physical precious metals if you have not already. I recommend a minimum allocation of 10 to 15% of your investable assets in physical gold and silver stored securely outside the banking system. This is not a trade. This is a long-term hedge against systemic risk and currency debasement. Third, you need to start looking for deep value opportunities in distressed credit and unloved sectors. This requires research and discipline, but the asymmetric upside is enormous. Look for quality businesses trading at multi-year lows, strong balance sheets with mispriced debt, and sectors that are being irrationally punished by the market. Fourth, consider adding exposure to inflation-leveraged real assets. This could be through commodity ETFs, precious metals miners, energy stocks, or even direct ownership of productive land. The key is to own things that have intrinsic value and pricing power in an inflationary environment. And finally, stay informed and stay flexible. The credit markets are dynamic and the situation is evolving rapidly. You need to be monitoring spreads, central bank policy, and macro data on a weekly basis. This is not a set-it-and-forget-it environment. This is a moment that requires active engagement and strategic positioning. Before we wrap up, I want to ask you a direct question, and I want you to answer it in the comments below. Do you believe the credit market stress we are seeing right now is a temporary blip, or is this the beginning of a larger systemic breakdown? I am genuinely curious to hear your perspective because the debate happening in the macro community right now is intense. Some analysts believe central banks will step in and backstop the credit markets like they did in 2008 and 2020. Others, myself included, believe we have reached a point where the debt burden is so large that no amount of intervention can prevent a major dislocation. I want to know where you stand. Drop your answer in the comments and let's get a real conversation going. And here's the final piece. If you found value in this breakdown, if you understand that what we just covered is information you will not get from CNBC, Bloomberg, or any mainstream financial outlet, then I need you to do two things. First, smash that subscribe button and turn on notifications so you do not miss the follow-up videos as this situation develops. I am going to be tracking credit spreads, precious metals, and macro data in real time, and you need to be plugged in. Second, share this video with anyone you know who cares about protecting their wealth. This is not the time for gatekeeping information. This is the time for community, for education, and for preparation. The credit markets are flashing red. Lenders are stuck. The systemic dislocation is here. The only question left is whether you are going to recognize it in time to position yourself on the right side of the trade. I will see you in the next one. Stay sharp, stay prepared,